Well, it's old news now that the Reserve Bank has delivered the first interest rate cut in 5 years, and while investors and mortgage holders are breathing a sigh of relief, what does it really mean for our housing markets? In today's show, Brett Warren, National Director of Metropole, quizzes Dr. Andrew Wilson and me about the implications of the rate cut, what lies ahead for our housing markets and the economy, and when further rate cuts are likely to occur. So welcome to another episode of the Michael Yardney Podcast, where we help investors gain clarity amongst the confusion of the many mixed messages regarding our property markets so they can develop the financial freedom they're looking for through strategic property investment and smart money management. Lots to discuss, so let's get on with the roundtable discussion and find out what's in store.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, it's Brett from Metropole here, and interest rates have fallen. It's official. Are there more to come? And more importantly, how's it going to affect our property markets, our economy, but most importantly, how it's going to affect you and what opportunities may lay ahead. So let's start off with Michael, who is our founder of Metropole, has had over 5 decades of property investment experience. I'm also joined by Dr. Andrew Wilson from My Housing Market, who is also going to talk to us about the economy and has a wealth of experience in that department as well. So starting with you, Michael, are there more to come? I know there's a lot of economists suggesting there may be another 3, 4 or even 5. I don't know how they can predict that far ahead, but your thoughts on are there more cuts to come?
Well, in the past, when the Reserve Bank cuts interest rates, it doesn't do it just once. It usually does a number of 0.25% interest rate cuts, often at each meeting. At the moment, they don't meet every month like they used to. There are fewer meetings, but they're not only going to look at inflation before they make a decision on the next interest rate cut. They're going to look at how our economy is going. They're going to look how the labour markets are going. They're going to want to make sure that the economy is not getting too overheated, that people are now feeling more confident and going to spend more, borrow more and push inflation up. So it's going to be a bit of a balancing act moving forward, but from past experience there will be further rate cuts because the intention is to bring interest rates down to the point where they're no longer going to dampen the economy but not too low to stimulate the economy. And that Goldilocks rate, no one really knows what it is, but it's usually maybe a 0.5%, 0.75% above their 2 to 3% interest rate target. So interest rates may fall all up 0.75% or so over this cycle.
Andrew.
Well, look, an interest rate cut is unequivocally good news for mortgage holders. It will only act to stimulate an already strong economy going forward. It's going to weaken our dollar to some degree because the US have kept their interest rates on hold, so we're moving down while interest rates in the US are flat. But in the likelihood of further interest rate cuts, I think are problematic given unless we see what the data is coming forward, because it will undoubtedly act to stimulate the economy, will create more jobs, more demand. And that, unfortunately, in an economy where we already have a labour shortage, will put upward pressure on employers to be able to cover prices costs or wages costs with higher prices, and that's the jeopardy for the Reserve Bank. As I said, it's an interest rate cut. It's a positive for mortgage holders and the economy, but it's an unusual circumstance because our economy is doing so very well.
Do you get the sense from the commentary that may just be a toe in the water? And I guess in the past it has obviously occurred quite rapidly in some cases and multiples, but in this particular instance they may wait for a little while.
Yeah, look, I think that's the case. Other rate cut environments have been with a weakening economy. We certainly don't have that. And I think perhaps it's a signal saying that, look, they've said that inflation was the bogey. They're happy that inflation is moving towards the target, so they've acted on that. But I think they're still very much aware that they could unleash inflation again by too much stimulation. And I think this is just enough to sort of say, well, we're sort of, it's not a victory lap, but it's signalling that, we feel we've got inflation where we want it to be at this stage. But I do think they'll be guided by the data going forward. And it won't be just the inflation data, it will also be what's happening in the economy, And I think, they were also guided to some degree with the cut by the GDP numbers, which have certainly been quite poor, And there's an argument that perhaps GDP gets too much focus, that it's a construct, an economic construct that, it doesn't seem to be relevant to other measures of economic performance like the labour market and retail sales, these sort of things. But they've still got to acknowledge that, GDP is the fundamental source of what's happening in our economy, and it has been a poor performer, and that's probably another reason why they thought they could go ahead with a rate cut. But I'm not sure they'll follow it up without really, substantial data to support it. Yeah.
Great. Now we have had a cut. What generally happens over the short to medium term in our property markets when this does happen? What kind of things do you notice pretty much straight away?
Well, what happens is confidence returns. People have been waiting for this. Well, I guess for a couple of years. But at the beginning of last year, 2024, when there was the anticipation of a rate drop, the property market picked up quickly as buyers got in anticipation of it. This time round, now that rates have fallen, people are going to get a level of confidence that they can go ahead and buy a new home or buy an investment property. They're not going to get caught by higher interest rates or rising interest rates. People who've got mortgages who are wondering, should they upgrade, should they downgrade, should they right size? People who've been sitting on the fence are now they've been waiting for something. And confidence is one of the big drivers of our housing market. So it's very likely that the housing market's going to pick up quickly. Previous experience has shown that after longish periods of flat interest rates, when they suddenly drop, the studies I've read have shown that in particular in Sydney and also Melbourne, property values increased very quickly because buyers got in, but there just weren't enough houses for sale. So supply and demand pushed up values.
Andrew, with the economy, we spoke before previously that it may not make a big difference to the economy with just one rate cut, but I guess what are some of the risks you're mentioning before if they do go ahead quite quickly and start cutting? I know everyone likes to mention the word recession at some stage, so maybe I guess your thoughts on what may happen and some of the risks around that, because it's important to understand the risks as well as all the upside, and I think you give a good viewpoint on that.
Well, I think, the word recession is reasonably irrelevant in terms of how strong our economy is, because if we got a recession defined by 2 quarters of negative growth, again, it sort of reinforces the nature of GDP as a focus for what's happening in the economy. I mean, it'd be a little strange if we had a recession because GDP tracked backwards over 2 quarters and yet we had 4% unemployment, It'd be like, well, we've got a recession, but I got a great job and I'm earning a lot of money and I've just bought a new house, but we're in a recession, you know what I'm saying? And that sort of brings back this whole sort of nature of what these sort of economic constructs mean, And in previous periods when we have had interest rate cuts, we were heading towards a very poor performance, not just in GDP, but also in our labour market, So it was sort of all working together. Consumer sentiment was down, consumer spending was down. But I think that, the Australian economy has proven to be remarkably resilient going forward. There are really no holes in the economy at the moment, other than what we have to confront internationally, and who knows what that brings.
Very good point. Michael, we may indeed get another, further 2 or 3 rate cuts. What do you think that will do to our markets over the next, say, 6 to 12 months?
Well, I think it's going to bring the property cycle to the next phase, the next stage of the cycle, because it actually reached its peak where affordability just held back further property price growth and also actually rental price growth because people couldn't afford it. But if people can pay more because their mortgages cost less, affordability increases, and people tend to borrow to their limit wherever they can, whether it's first home buyers getting into the market or whether it's established buyers upgrading. The other thing is there's a lot of people with a lot of equity in their homes. So we talk a lot about first home buyers having difficulty getting in the market, but people who bought even a couple of years ago in many states, and definitely before COVID, have got substantial equity in their properties, and they're now going to want to get on with their lives, move on. Some will get married, some will get divorced, some will have babies, maybe not in that order, but what's going to happen is they're going to get on with their lives and they're going to move on. I think the other thing we're going to notice is that with property values going up, the bank of mum and dad's going to be out even more active helping their children into the market. I recently read a statistic that the average gift the bank of mum and dad gives, gift loan, whatever you want to call it, is $200,000, which is sort of a deposit of a medium priced property in most of our capital cities.
That's a good point. If they do cut too quickly, there are some certain risks there, I guess, that you've kind of elaborated on. What could happen if we did cut too quickly?
Well, it's going to overstimulate the economy, and that puts upward pressure on prices. And then you're back to where you started from, and you're still exposed to factors such as the international price of oil, which is anybody's guess where that's going to head. A lot more uncertainty over the international economy, given change of jurisdiction in the US. And so I think the Reserve Bank would be quite happy to sit. I think their decision on balance was one that they decided to go forward on, but to really wait and see how the circumstances work out before they move ahead. They're more likely to have a period of lower rates, as we did during the GFC, as we did during the COVID crisis, if there was a significant, shakeout in the economy. And there's just no signs of that, even at a starting point at this stage, And we're also a hostage to what's happening internationally, and the US economy is booming still. And our dollar, if we continue to cut rates and the US didn't, our dollar would be, worth 2 and 6 eventually. So I think those factors the Reserve Bank would be very mindful of. But they're probably happy to say, okay, well, we're just saying we're happy what we've done with inflation. We think it's moving towards the target range sustainably, but we're just going to wait and see now going forward. So don't hold your breath for another rate cut anytime soon. We'll see.
Once we start getting a few rate cuts, does APRA come into things and maybe looking at that serviceability buffer, or is that not even in the conversation at the moment?
Well, of course, because the more affordable you make property, the more demand you have to create, because we're always we're a housing market where there are more people who want to buy than can buy. So you've always got that untapped, resource of people who want to get into the housing market. If you're making that easier, you're increasing the risk. But I think banks still maintain very rigid, sort of conditions. 80-20 LVRs, you can't repay more than 25% of your income as a repayment. So as long as they maintain that, the market, remains quite secure, and that's why it has remained secure over the longer term. But I think it's wishful thinking to get a number of interest rate cuts. Of course, it'd be welcomed by everybody. But you don't want to be sort of getting these cuts now and then, hey, we've got to put up rates again, folks. Sorry about that.
It wouldn't look good, would it?
Wouldn't look good.
That together with APRA lowering the serviceability buffer would really stimulate a property boom. And I don't think APRA or the Reserve Bank or any of us want that.
Yeah, it's another layer of risk management, and that's fine. Let's keep that. It can't hurt in a sense. Yeah, people will be like, oh, gee, I'm restricted from market entry, but it just makes the whole market, more secure going forward. And as I said, we've got to also understand that we've still got some very, very strong housing markets out there at the moment that are really showing no sign of slowing down, and that's Brisbane and Perth particularly. So that's going to be, hidey-ho for those markets with an interest rate cut. So it won't be too long, I think, that before the Perth median house price is higher than the Melbourne median house price.
Well, I can go back to 2006 and 7 when it was Sydney and Perth, remember?
That's right. Perth was the highest in the land.
It was.
So,
Michael, you mentioned before that potentially a few more rate cuts, it may lead to another cycle starting, or the beginning of another cycle. If that's the case, where are you sensing a lot of the opportunities?
Well, over the last couple of years, it's been the more affordable houses that have outperformed because of, I guess, affordability, and the upper end of the market and even the middle ring suburbs particularly in Melbourne and Sydney, haven't performed. People just have sat back and they haven't been moving house. I believe that a 0.25% interest rate cut like we've experienced, or even another one, that if it does come, isn't really going to change the budgets of many households that are going to still be struggling a bit with the cost of living and their mortgage costs. But I think it's now going to rekindle the middle and upper end of our housing markets, the established housing markets.
And surely after such a huge amount of growth around Australia, there's only really one suburb or one state that hasn't really done that well. So potentially Melbourne may have an opportunity to move forward over the next 12 or 18 months.
Melbourne's fundamentals are very strong. You can buy an established property with significant inbuilt intrinsic value, in other words, significantly below replacement cost. That can't continue on. One eventually gets back to, some would call it mean reversion. In other words, Melbourne property values can't be so much lower than Sydney or Perth or other states as well. So that will happen. What will rekindle that? It's going to be confidence, and maybe it's interest rates. It could be a change of government. It could be other things, but this will definitely be a positive for the Melbourne housing market.
Thanks, Michael. Andrew, to finish off, from an outsider's point of view, where would you recommend investors consider and look at?
Well, I think, I've been saying for some time that Melbourne is an opportunist market. I've no barrier to push, but it's clearly a market that's fallen away compared to the performances of other capitals. There's no real reason for that other than confidence, because the Melbourne economy is still performing quite strong. In fact, Melbourne creates more jobs on an annual basis than any of the other capital cities. So even though its unemployment rate is a little bit higher, its job growth is number one.
And population's starting to...
And population, it's the engine room for new home building, Melbourne. It's clearly, in my opinion, a confidence issue. And part of that is starting to turn. What we've seen is a revival in rents in Melbourne over the past 18 months. And of course, what that's doing is pushing up yields. And some Melbourne suburbs, you can get yields as high as 8%. And that is a clear turning point for the market, because investors start to think, hey, this is really good value. I can get into the market, at a low point compared to other capitals, and I can get this great return, and the fact that vacancy rates are still reasonably low. So it's not as though you've got to struggle to get a tenant anyway. So I think those points there are fundamental to describe that Melbourne market as being an opportunist market. And at the moment, the Melbourne median is at a 10-year low versus the Sydney median, a 10-year low. And as I said, the fundamentals, you can't point to any sort of underperformance. It's not like back in the early 90s when, Melbourne had an unemployment rate of 14%. It's and was well ahead of everybody else.
Defaults in mortgage rates.
It's just, it is a confidence factor. I think Melburnians have continued to sort of suffer, from that terrible COVID lockdown experience.
Yeah, I agree.
And particularly in those aspirational markets in the inner city, which have really been dragging the chain, because, those markets, inner east, inner south and inner city, just the change up, the changeover buyer has just been sitting on their hands.
Yeah.
And I think, once we get that spark of confidence back and that market moves, that the Melbourne market would turn around. And the other point to that, just quickly, is that, as Michael said, the mid to lower price areas in Melbourne have continued to grow. So eventually they're going to sort of start catching up with the higher price. I think, hey, I can get into this suburb now, and it'll create that other wave of interest.
It's interesting you mentioned investors there, but it's also homeowners, right? Because we're starting to get people at Metropole who are coming back and breaking their lease because rents are continuing to climb. Yeah. And all of a sudden, if interest rates come down, it's going to be cheaper to buy a property. So we're starting to get that. And I actually think it'll be the homeowners that drive that market. And particularly the people who have come back to Melbourne and moving to Melbourne. It's probably going to take a year or two for them to settle. And we're getting into that phase now. So it's going to be interesting to see what happens.
And I think that we're going to see... maybe sooner or later, where people saying, gee, I remember I could have bought that house down the road there for this, and look at it now, oh, gee whiz, I should have got into the market.
It reminds me, Michael, we had a conversation probably a decade ago, and we were talking about the Brisbane market, all the long-term fundamentals, and the interest rates were good, and you told me there was one thing missing. It was confidence, and we're having similar conversations.
And look at Brisbane now.
Look what's happened to Brisbane. Look what's happened to Brisbane apartments, where everyone lost their confidence. And the latest My Housing Market figures showed that Brisbane apartments grew over 44%.
Well, nearly 50%.
Yeah, wow.
2 years.
Amazing.
2 years.
There we go. We'll wrap that up, guys. Hopefully you found that very valuable. Some information on interest rates, the economy, the housing market, but most importantly, some information for you to actually make an assessment to move forward. We talked a little bit about the opportunities that exist, and there are going to be opportunities. If you buy a property today, no matter where you are around the country, if you buy a good property, an investment grade property in an amazing location, chances are you're going to be further ahead in the next 12 months. Also, the chance of a recession is very, very limited. Our long-term fundamentals are very strong. The chance for more rate cuts may not be a waterfall like it has done in the past. It may take time to wash out through the system, but there's certainly opportunities that exist. If you would like to plan to become the person you plan to become, why not reach out to the team at Metropole to actually help you guide and put a personalised plan in place that'll suit your requirements, lower the risks, you're safer with Metropole, and you're going to achieve above average rates of return.
Well, clearly there are some interesting times ahead for our housing markets, and I hope my chat with Andrew Wilson gave you some insights into that. And before I share my mindset message with you today, which is about balance in life, I'd like to share another quick lesson, a lesson I learned from my mentor, one of my early mentors, Jim Rohn, about the law of diminishing intent, which says the longer you wait to do something you know you should do, the greater the odds that you're never going to actually do it. Now, that's true. Now, I'm partly talking about Wealth Retreat, but that's just a shortcut, a proven means to an end. I'm also talking about investing time to set clear, compelling goals based on your personal purposes, your priorities, and your potential, now that the market is going to move to the next phase of the property cycle because interest rates are falling. So if you know getting goals and plans in place is something you should do, then don't put it off another minute. Grab your calendar, block the time, and commit yourself to the task. Of course, if you need help finding the right time, the right place, the right mindset, the right materials, it's all waiting for you in a turnkey package at Wealth Retreat 2025 on the Gold Coast at the beginning of May. And that's not too long away. So why not go to wealthretreat.com.au and express your interest and reserve your early bird savings. It's been said that most people spend more time planning a vacation than designing a fulfilling life. That's because of procrastination, the tyranny of the urgency, or no clue about how to set effective, meaningful goals. But you can conquer all three with one decision, one great decision to get away from the daily grind for a powerful 5 days training, effective goal setting, networking and masterminding, where we help you design the next 5 years of your life. That's the theme of Wealth Retreat. Where are you going to be in April 2030? That's 5 years away, or May 2030, I guess, which is when Wealth Retreat's going to be. But not only in property, but holistically. You're going to arrive on Friday with ideas and with dreams, but you're going to walk out with Wednesday with goals, plans, and a toolbox full of new tools to define all areas of your life, including finance, property, health, relationships, contribution, spirituality, and much, much more. Real, true wealth. True wealth is more than just money and property. And if those 5 days make you even 1% more focused, fired up and effective in 2025, what would that be worth to you? And what if you finish the next 5 years even just 10% better in those areas? What would that be worth to you? So remember, you're your best investment. It all starts with a clear vision, defined goals, and a motivating plan. So make it happen. Go to wealthretreat.com.au, find out more about it, register your interest, and we'll have a chat, because if you really want to join us, I'll even chat with you personally to make sure you'll benefit. And if you do join us, you're going to be covered by my money-back guarantee. wealthretreat.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to discuss with you the concept of balance. I think the idea of having a balanced life has been hijacked. We've been led to believe that your life should always feel balanced. Often on a micro daily basis, you should have a perfect balance of work, health, family, and personal time. And I've actually found this leads to a lot of stress and anxiety when your life starts to feel dislocated from this aspirational reality. Fortunately, I've come to realize that balance is much better found and understood on a big picture, on a macro, on a seasonal basis. In reality, life's filled with challenges, painful trade-offs and sacrifices. And if you want extraordinary results, you're going to be needing to be willing to contribute extraordinary inputs, and you're going to have seasons of unbalance with this. There's going to be some days that are going to be very work-related, and then you're going to have other times that you spend time with the family or recreation or friends. But this unbalance, in my mind, is a necessary fee for the entry for future balance in your life. So at this stage of my life, it is much, much more balanced because I've got a big asset base. I've got a business that brings income in. I've got the options to do what I want when I want. But in a recent blog from Michele Bullock, I read a great concept that may help you with the idea of balance. I mean, traditional wisdom contends that in each area of your life, work, relationships, health, it exists in a sort of switch on-off, an on-off switch, a bit like an electric light switch. It would say that you can have one of two areas flipped at any point, and then other areas in your life are going to be flipped off. I mean, the problem with this mindset and practice of having bits on and bits off is that if one remains off for too long, to turn on again. If you don't invest in your relationships in your 20s and 30s, you won't have them in your 40s. If you don't invest in your health in your 40s and 50s, you won't have it in your 60s. If you don't take care of your mind in your 60s and 70s, you won't have it in your 80s. Fortunately, you need to accept the self-limiting nature of this dangerous mindset of switching on and off areas of your life. So Michele Bullock suggested a new mindset. Each area of your life exists, he suggested, on a dimmer switch rather than an on-off switch. So as you prioritize and focus on one area during the present season of your life, he suggested you turn the dimmer down low on others rather than shutting them off. That means continuing to do daily tiny actions in those areas. Remember, anything above zero compounds. In other words, just do little bits and it's going to work. So with this simple shift, you can win the present season's battles, but avoid losing sight of the multi-season war. So I guess the message I'd like to explain to you is, while day by day your life shouldn't really be hard to make your life balanced, if you balance it out over the weeks and over the months and over the years, then, well, more likely, importantly, over the weeks and months, then things are going to work out okay. How do you do that? Well, I know I set aside time in my diary. So every Tuesday and Wednesday afternoon, I've got time set aside to visit my grandkids, pick them up from school, play with them. But I've always done that. I've got time set aside for time with my wife, Pam. We have time set aside in our diaries for vacations, and we plan that so that other things don't get in the way. So, as I said, balance is about seasons, not about days. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Well, just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?